This is Andrew Stotz of Stotz Investment Research, talking about our value model for PTT Global Chemical in Thailand. First, the disclaimer. This example was created on the 24th of January, 2017. What follows is not a valuation, forecast, rating, or recommendation. Rather, it's a teaching example. What follows is not investment advice. Rather, it's a teaching example. It is intended only as academic information to those who want to learn about valuation. It should not be construed as the basis of any valuation or investment. The information in this presentation came from various sources which we believe are reliable, though we do not guarantee the accuracy, adequacy, or completeness of such information. We hope you enjoy learning about valuation as much as we do. So let's get into PTT Global Chemical. First, the company is a 49% owned subsidiary of PTT, which is another listed company related to the government in Thailand. It is Thailand's largest fully integrated petrochemical and chemical company operating in refinery, olefins, and aromatics business, accounting for about a third each of the company's revenue. PTT's refinery business contributes 34% of revenue, and it is a leading petroleum refiner in Thailand, supplying refined petroleum products such as LPG. Its olefins business contributes 33% of its revenue. The business manufactures and distributes olefins products using natural gas and naphtha as its feedstock. Aromatics products are used to make automotive and electronic parts, clothing, and food packaging, and for PTT Global Chemical, these generate 20% of revenue. So the revenue breakdown as 9 months, 2016, refining 34%, olefins 33%, aromatics 20%, and the remainder is others. Let's talk about the forecast section. We have to first create a forecast if we want to value any company. So let's take a look at this forecast that we have right here. First of all, what we can see is that because this is a energy-related company, it can be very volatile. In fact, it can have a falling revenue. As we can see, revenue growth negative. Now, most companies are going to go up and up in their revenue, but in this case, it's a cyclical company. And that also means that the revenue can eventually come up, as we see right here. Now, here you're going to face a problem with a forecasting revenue of a cyclical company. So if we say that the revenue of a cyclical company is going to go up, then down again, and then up, should we continue this cycle as we forecast throughout the years? Or should we try to get some kind of average, let's say? And my answer to that is that you can never really predict these cycles. Therefore, it's probably best to just go with an average, knowing that this company over time could be above the average, and it could be below the average, and it could be above. But that's way too complicated for what we need to do. We need to think about the future, right, in this way. And that's the way I look at it. Now, we can see the net profit margin recovers here, and we're going to hold it flat again because we've kept things flat in the overall company. So you've already learned something there about the cyclicality and what to do about cyclicality. And what we can see here is that our growth assumptions are pretty low on the asset side, and we're not expecting major changes in the asset turnover, which you can see going from 89 to 98 or so. From a borrowing perspective, the company's borrowed less and less, and now this is short-term borrowing. We're going to keep that relatively stable. Now, long-term borrowing of the company, well, that has maintained pretty steady, and then we're going to have it actually fall slightly over time. The dividend payout ratio of the company hovers between 60 and 50 for the data we have here, and we're going to keep that for future. Next, let's take a look at the cash flow statement, the operating cash flow, and we can see massive amount of operating cash flow. Why is that? Because it's a heavy fixed asset business, which means depreciation that gets added back can be very, very massive. In this case, they've also had gains on net working capital. So the result of that is that the amount of investing cash flow that they've had is like half of what they're producing as far as operating cash flow, and that leaves a lot of money left to be paid as dividend. If we go forward, we can see our forecast is that that's going to maintain its steady growth right there, and that asset spending on CapEx An investment will be strong and flat, but that will always leave enough money to pay a pretty darn good dividend. Now we can see operating cash flow as a percent of sales rising here as recovery in net income happens, and then we're going to have it at about 12% or so. So next, let's talk about the valuation section of this company. And what we can see here is that the NOPAT is always positive, and that we have this large amount of capex, and we are forecasting change in working capital to be negative over time. So there's an investment amount that's pretty significant. But the end result is that the free cash flow to the firm is relatively strong and rising quite a bit. And so we see some very strong growth in free cash flow to the firm here. So now if we continue on to the next page, we can see the invested capital in the business. That's the debt plus the equity minus this non-operating cash and investments. So we can see that there's a pretty steady amount of invested capital in the business. In fact, if we look at the growth rate of invested capital, including or excluding cash, it's pretty low. And we can see that that will be continued going forward based upon our estimates. The return on invested capital, 9% was the peak, come down a bit from there and then come back up. So a reasonable return on invested capital. So now let's move on to the next section, which is the EPS growth. And we can see, since it's had a pretty significant recovery, maybe a small fall, and then starting to rise and grow again. Now, in this case, the dividend payout ratio will be rising and then rising. And so we will see that dividend per share in this case will rise by 19 and 16%, which is faster than the EPS growth because of the payout ratio. So now, if we look at this company, we have our assumptions for Thailand right here, which is 4 for the risk-free rate, 8 for market premium, which gives us a market return of 12%. The company is relatively volatile, so we're going to give it a 1.25, which is what we put on a company when we think that it is high risk. And high risk meaning that it's volatile in its revenue and its earnings. So a 14% cost of equity. Now the company has in its capital structure about 77% of capital structure is coming from equity. So we can see that the company can get a very good cost of debt of 4.4 recently, and then let's say up to 5. But they're always going to get very close to the government rate because they are partially owned by the government. And so the result is that the weighted average, the cost of equity is higher than the weighted average cost of equity right here, right? Because of the amount of debt that they do have, which is a small amount. So now if we continue on, we can see we make an assumption of 1% on the terminal growth rate, and we have a 5-year fade period. The fade period, remember, is the red line. And then from this, we can see that a final multiple that we use at that point is, for the terminal value, is about, let's say, 8 or 9 times. So a reasonable multiple. Now, let's look at what that comes up with from a DDM, free cash flow, and free cash flow to equity. These are all absolute valuation measures. So let's see what we get. And first thing I always like to look at is what percent of each of these is coming from that discrete period. And we can see that in the case of the free cash flow to equity, the least amount is coming from this discrete period, and dividend discount is the most is coming from that discrete period. So what we can see from this then is that we get a range of values from, let's say, 35 to 75, so almost double what we can see. And the result of that is that the price is sort of in the middle of the two. As we almost always see, the dividend discount model output tends to be lower than the share price. It's a conservative measure, and the free cash flow to equity in this case appears to be the highest. So is it cheap? Is it expensive? Well, I'd say it's kind of middle of the road. Okay, let's move on to multiples and understand this company relative to its global peers. The first thing we can see is that the multiple is about 10 times, and when we compare that to Thailand, it's about 11 times, so it's a little bit cheap. And compared to Asia, a little bit cheap compared to Asia, and definitely cheaper than most of the world for this sector, which is called the materials sector. Now, we can also see that it had negative earnings growth when Thailand had positive, and Asia had positive, and the world had positive. And then we returned to kind of in line, let's say. So the end result is that this company appears to be attractive, but the truth is that it probably is not that attractive. On a PEG ratio, it appears to be like super attractive down here, but the fact is that the amount of EPS growth, if you average these two, which we're doing, is pretty low. So maybe it may make sense in this case for an analyst to say, well, I'm only going to look at this information for 2018 rather than 2017 because that negative just throws it off. That's up to the analyst, of course. Now, here we can look on the price to book side and we can see that it's cheap relative to Thailand, but not relative to Asia ex Japan. In other words, maybe Thailand material companies are too expensive. But when we look at the world, it's cheap relative to the world. And the ROE is slightly lower than Thailand, so that kind of makes sense that it's cheaper. But how much cheaper? Well, that's where this helps us to see, right? This is the price to book, so how much ROE do we pay for with price to book? And we can see from this case that the company is slightly cheap compared to the others. So the end result of the valuation is, I'd say it's kind of moderately attractive, possibly. Now, of course, that's assuming that our forecasts are correct. They could be wrong, and any of our numbers could be wrong, and then we're completely wrong. So now let's look at the sensitivity analysis, and what you see is that this company operates on a really thin gross margin. So if we were to increase gross margin to 15 or to 5% in this case, we're going to see a pretty significant fall or rise in the EPS growth. So there's a lot of volatility there. And then the second thing is the free cash flow value of free cash flow to the firm valuation can vary quite a bit based upon that change. So remember that we look at sales growth, we look at margin change, we look at discount rate, and we look at terminal growth rate. So there you have it for this company, and you can think about it yourself. Is it cheap? Is it expensive? What do you think? Let's keep learning.